Hi, everyone. I'm Mark Sir, Product Manager at Saving for College. And on behalf of the whole team here, welcome to today's 529 Basics webinar. We're so glad you decided to join us today, and we're very grateful for all the excellent questions that came in during registration. We're going to try to answer as many of those as possible today, while also sharing relevant tools and content to help you make better college savings decisions. So I'll answer all of these questions and also take you through some of the tools that we offer at Saving for College that'll help you make some better choices. So if you do have any questions or need clarification on anything as we go through today's presentation, please feel free to include them using the Q&A function here in Zoom. And also have the chat box handy because I'll include the links that we show here on the screen today that you'll be able to follow along. Every 529 plan has different provisions based on the specific state that sponsors it. So it's really important to be able to look at, what is specifically relevant to you. And if you do miss anything, don't worry about it. We're going to include all of those resources in our follow-up email, as well as, of course, the recording of today's session. We'll have that on YouTube. And so today we're going to start with some information mostly relevant to people who are just getting started in the college savings process, right? How much they should save for education, some of the key benefits of a 529 plan compared to other savings vehicles, important considerations when choosing the 529 plan that you're going to open. And then we'll discuss, qualified expenses, a little bit of information about withdrawals. I think it's really important to know how you're going to get your money out if you're going to put it into an account. So we'll make sure you get those details. And of course, the recent legislation enabling 529 plan to Roth IRA rollovers, which kind of assuages a lot of concerns about leftover 529 funds after your student's done with college. So first question a lot of people ask, when they're starting to save for college is naturally, how much should I save for college? And that's, of course, a really difficult question to answer. It's very difficult to project where your student's going to go to school, how much it's going to cost by the time that they're actually there. And when you're talking about, a 15, 18-year time horizon, super difficult to project that. And it's also very discouraging when you look at these really high sticker prices, try to project that 18 years into the future. Now you've got, this six-figure sum that you're trying to save for. And that's just really discouraging as you try to get started. And so I'd like to kind of reframe that question to how much student debt can I avoid? And so we've got this really useful tool here that I'm going to drop in the chat for you all so that you can come in and play with it a little bit. Very simple tool, but I think it's really helpful in understanding how powerful it is to save early, even save a little bit. Here's a really simple example where we're trying to pay for $5,000 a year in school. You can project the inflation here if you'd like to. Right now, I'm just saying I want to be able to pay for $5,000 worth of school for 4 years in the future. My child's 3 right now. How much, can I save by saving now and not going and borrowing student loans? And in this example, we see that we would be contributing $14,500 over the next 15 years or so. But we would actually pay closer to $30,000 over time if we decided to take the loan out instead. And it can actually be really powerful even when you're looking at a student who's already in high school, right? Obviously this would require much higher savings up front. But still, almost $10,000 in savings just by getting started now rather than waiting and borrowing student loans. Especially now, you see those student loan interest rates continue to rise as the market interest rates do. So I hope that helps kind of reframe that for you a little bit. Definitely check out this tool, play around with it a little bit and see how powerful it is, to save as early as possible. So we at Saving for College really think that the 529 plan is the best way of saving for college. And I think of these three key aspects of a 529 plan compared to other savings vehicles that are really attractive. First is, of course, your tax benefits, right? It's a tax advantage account, meaning you're not going to have to pay federal income or capital gains taxes. So if you're saving in a brokerage account, obviously, the taxes that you pay there are going to eat into your returns. That's not the case with the 529 plan. So that's obviously, a very powerful aspect to it, especially if you have a lot of time to get started and a lot of time to build up those earnings. Really high contribution limits and also low contribution minimums. You can typically get started in a 529 plan with as little as $25. So, there's really no reason not to get started. And you're able to contribute typically, over $250,000. I think every single plan has a maximum contribution limit, in excess of $250,000. There are no income limits as there are with, say, a Coverdell ESA, or if you're going to use a Roth IRA to pay for college. Those, income limits apply there. That does not exist with the 529 plan. So it really is, available to a broad array of user. And of course, the control and flexibility is super important, especially grandparents consider the control aspect of it to be, really critical. With an UGMA or UPMA account, for example, once that gift is, bequeathed, it's not revocable. Whereas with a 529 plan, you can name your designated beneficiary, but you also retain control of the assets as the account owner. So that's something, a lot of people who are not the parent of the child going to college finds, really valuable and flexible with the 529 plan, being able to change the beneficiary. And now as the list of qualified expenses gets longer and longer and options for leftover 529 plan funds, become more significant, there's just a much more attractive flexibility control with a 529 plan than some of your other accounts. I'll touch just very briefly on financial aid. This is always a really common question. It can get very complicated, which I think is a little bit needless, because 529 plans, while the funds do impact financial aid to a degree, they impact financial aid much less than any other type of account. So like an UPMA, for example, that's considered a student asset, right, on the FAFSA. One, because it's been now, gifted to the student. So that's going to have a more significant impact on the student's financial aid, since the expectation is that a greater proportion of a student's assets or income are going to go toward their education. Where a 529 plan, this is always going to be considered a parent asset. So that has a much lower, expected contribution from that asset pool. Now, there used to be a really big concern with grandparents and other loved ones where the distribution from that 529 plan would be considered the student's income, right, once they receive those funds. That's no longer the case, thanks to the recent FAFSA simplification. So financial aid, no longer a major concern for grandparents and other loved ones who are trying to save for college. So that's a really nice positive. We're going to have more in-depth webinars about financial aid issues. I know there are a lot of questions about those, but we're going to try to stick with the basics for today. And these are two key points that I wanted to make. And basically that the 529 plan is a much more attractive vehicle compared to others when it comes to financial aid considerations. A couple of just little provisions I want to touch on that are, exclusive to 529 plans, and that's why I wanted to mention them. Super funding, very popular amongst grandparents and others who have had, maybe a little bit more time to accumulate assets. Use this as a estate planning strategy. So you're able to actually declare 5 years worth of your gift tax exclusion by contributing to a 529 plan. So you do that 17,000 times 5, and you're effectively increasing your contribution limit to $85,000. So it's a very unique provision that allows, a grandparent to reduce their taxable estate by $85,000 right away. So very, very, attractive for grandparents and others who maybe have a little bit more in assets. And then the tax carry forward, we're going to get a little bit more into the state tax benefits here in just a second, but there are a few states which actually allow you to take your state tax benefit and carry it into future years. So there's a higher limit on the benefits that you can receive. So that, again, unique to a 529 plan and to be aware of. And I'll share a link here in just a moment where you'll be able to go ahead and take a look at what your state's tax benefits are and whether they allow carry forwards also. So, now that we know that a 529 plan is a pretty attractive vehicle when we're saving for education, there are over 100 available. How are we going to choose one? The first consideration, as I'm sure many of you know, is there a state tax benefit available? And over half of states do allow either a deduction or even a credit for 529 plan contributions. And so here we illustrate where 529 plan tax deductions or credits are available. So, you can see that Indiana, for example, has a really attractive credit where you're able to, essentially get free money for college, which is, super attractive. If you live in one of these tax parity states, very important, you may contribute to any 529 plan and still obtain that 529 state tax deduction in your home state. So if you live in Pennsylvania or Missouri or Arizona, you should absolutely be shopping around and seeing, what 529 plan is best for you. So what to consider here, basically 3 different types of 529 plans. I do want to get a link here for you guys here so you can follow along. Pardon me. Yeah, if you come to this page here that I'll drop in the chat, you'll be able to click on your state, and then you can see, right, which plans are available in your state, as well as what your state tax benefit is. So I'm going to drop that in the chat for you, so that way you can kind of follow along here, because this is obviously quite critical here. So when you go to your state's page, you're going to see up to three types of 529 plan available. So most states offer a direct sold 529 plan. So these are kind of the simplest 529 plans out there, usually really easy to open online, very low minimum contributions required. They're typically, very simple investment options. The menu may vary. Some of them offer, relatively few investment options, while some offer quite, extensive menus of portfolios. Popular investment options are what we call like the enrollment year or age-based portfolios. And so that'll be kind of managed by the plan. So as the child is younger, there will be a higher allocation toward equity and higher risk investments. Whereas as the child, gets closer to that graduation, they'll actually move it into, bonds, maybe FDIC or stable value type investments to lower the risk there. So there you could kind of set it and forget it, if you will, and that'll be managed for you. And then you could also select individual investment options, right? So you'll have, maybe S&P 500 portfolio, maybe a static 60-40 stock bonds. Some of them have, more advanced options like international or real estate options. So definitely something to take a look at. If you work with a financial advisor, if you'd like to work with a financial advisor, there are also what we call advisor sold 529 plans. And so here you're going to have to work with a financial advisor if you want to open one. And typically you'll have, a much more expansive menu of investment options, since you'll be working with an advisor to actually help you through those allocation decisions. Obviously, with more exotic investment options and opportunity then for maybe higher performance, you're also going to have higher fees, minimum contributions. So you'll want to take a look at, what that plan has in terms of those things. And then there's a third type of 529 plan, which is becoming a little bit less popular. The most popular one, I think, is in my home state of Florida, the Florida prepaid 529 plan. This is often billed as prepaying tomorrow's tuition at today's prices. So you're able to kind of buy credit hours or buy, your tuition for your child at, say, Florida public institutions in the future, and then you don't subject yourself to the market exposure, right, that you do with a 529 savings plan, where you've got investments. But of course, you've got limitations on the school of enrollment then there. There is a consortium of private colleges which offers the private college 529 plan. And so I think there are maybe 300 institutions which participate in that, which is a prepaid plan for private schools specifically. So as we're considering, we've kind of touched a little bit on this, right? If we have decided that our state's plan isn't for us, if there's no tax deduction available, if we're in the tax parity state, what are some questions we want to ask ourselves? Obviously, what fees are charged? What investment options are available? Maybe you have some familiarity with the investment managers at Vanguard, Fidelity, T. Rowe Price, and you want to stick with those fund families. You can probably find a 529 plan then that fits you in that way. And then other restrictions on, the minimum or maximum contributions. And again, let's go and pull up a really useful tool here, which is our comparison tool of 529 plans. And let me drop this in the chat for you all really quickly. So what I've done here is taken three, and actually I should give you guys the more general comparison here so you can choose. So you can compare direct or advisor sold programs here. And we've got all of these different fields where we go and gather this information from all of the program disclosure statements. And so some of the things I've kind of mentioned here to take a look at: your total asset-based expense ratio. That's definitely important, and it'll show you a range there. Minimum contributions, I think, is relevant. And let's also look at underlying investments. That'll kind of show us what fund families, what investment managers the plans use. So this will allow us to take a look at, what our minimum contributions are, who provides the underlying investments, and how, the asset-based expense ratios range for them. And, we want to go ahead and read further. Just click right on the plan name, and you'll get this full plan details page where you'll get all of those same details. And you'll also be able to look very specifically at what investment options are here, right? So we'll have all of the age-based investment options. So these kind of correspond to when the child is expected to graduate high school. And you'll be able to see what the expense ratios are here. So you'll be able to compare different plans as well as the investment options and find the right plan for you. So this begs, a really good question, which is, if I'm saving for multiple children, should I have multiple 529 plans, or should I save for all of the children in one 529 plan? And to answer that, I'd like to pull up that comparison tool again and look here at enrollment or application fees, right? So this would be a fee charged to open a new plan. And we want to take a look at account maintenance fees. So this would be like an annual charge to keep the account open. And let's see, what we see here. There aren't any plans which charge enrollment or application fees. And it does not seem that there are any plans that charge an account maintenance fee which does not have some sort of a waiver available. So here, for example, the Arkansas Brighter Future plan, there's a $20 account maintenance fee, but that's waived for Arkansas residents who are obviously most likely to open the plan. And you'll see something similar, Colorado, also for accounts opting to receive all documents electronically. So that's a pretty low bar to be able to clear. So with that said, there aren't really an additional cost to having multiple 529 plans. And while I could understand, you might think that it's probably simpler to just manage one plan, I don't know that you'll actually find that to be the case. And that's because, well, for one, it's better to have the investments match up with the time horizon of the student you're saving for, right? They're probably going into college at different times. You're going to then have to change the beneficiary at some point in the future. That introduces, additional complexity to it. So in my view, it would be, much simpler to maintain separate 529 plans. There aren't, a whole lot of account maintenance things that you're going to need to do every year. So it's not as though there's going to be a ton of upkeep for you there. So now that you've already saved here, you've opened your plan, decided on it, what can you use it for? And obviously, very important question. Of course, there are the obvious things, right? Your tuition and fees, and your books and supplies. Room and board also applies to off-campus, right? So that's a very common question. Can you use the 529 plan funds to pay for an off-campus apartment? Yes. What you're going to want to pay close attention to is what the school lists as the cost of attendance figure, because you're only going to be able to allow to take a distribution up to that cost of attendance figure. So you're not going to be able to necessarily, get your kid a $5,000 a month penthouse apartment and then expect to be able to, take that as a qualified distribution. Only going to be able to get a distribution up to the amount of that school listed cost of attendance, which will be, very clearly published. Some relatively recent provisions and additions, up to $10,000 in K through 12 tuition. That's one you're going to want to watch out, though. Again, take a look at your state's plan page. You'll be able to see if that state does follow, that federal tax-free treatment. There are certain states which do not allow you to withdraw from a 529 plan for K through 12. The same applies to student loans. Recently now able to repay up to $10,000. That is a lifetime limit, I will caution you, but able to pay up to $10,000 in student loans. And so that's, very attractive also now. And apprenticeships also, any, tuition type costs related to apprenticeships, a recent expansion there. Two notable exclusions that I always need to highlight. One is health insurance. There will be maybe instances where health insurance will be billed by the school that is still, not a qualified higher education expense as far as, taking a 529 plan distribution. So please keep that in mind. And transportation, right? So whether that be flights to or from campus or, a car, those are not qualified distribution. So, don't try to do that. So this does, beg a very good question that quite a few of you have asked in registration. Can you use the 529 plan for either study abroad or an international school? And the answer there is generally yes. As far as study abroad is concerned, that will generally be billed as a normal tuition cost from your home university. So you'd be able to use your 529 for that, of course. And then also, as an American going to a international school, any school that accepts federal financial aid is actually eligible. And we've got another useful tool here that I'll add to the chat, which is kind of our eligible institutions listing here. And so what I've done, we've got under the states here, FC. And so that stands for foreign country. So you could actually, I had looked for Oxford, but you can take a look. There are over 300 schools which are, international and eligible to use your 529 plan funds. So yet another, flexible aspect of the 529 plan that your children will probably really appreciate. So, when we get to the point of making a withdrawal, I promise we'd cover this a little bit because I do think I messed that one up. It's really very simple to take a 529 plan withdrawal. So you want to calculate, your total qualified expenses based on what we just discussed. And very, very important here, withdrawals must be taken in the tax year the expenses are incurred. So do not take a withdrawal in December, make a payment in January for spring tuition, and then expect that December withdrawal to be tax-free. That's a really, really important consideration. Please pay attention to that. You need to take the withdrawal in the same calendar year that the expenses are incurred. So that's the biggest point that needs to be made on withdrawals. But requesting the distribution is really quite straightforward. The easiest way of doing it is typically on the plan website. So you'll obviously need, your typical information, the account number, your name, social security, as well as the beneficiary. And the distributions can be paid directly to the educational institution. So, that's the easiest way of taking care of it. You get the tuition bill from the school, and then you have the 529 plan just paid the school directly. That's, the best way of just keeping it out of your hands. You can have it generally paid to the account owner and also to the designated beneficiary. Of course, at the account owner's discretion, going back to the control aspect that we discussed earlier. And if you are curious, where your distributions can go, if we go back to our comparison tool here, there is actually an option for this, right? So under distributions and terminations, we can take a look at to whom distributions are payable. And we'll find that, we'll typically see the beneficiary, the educational institution, and then or as directed, by the account owner more generally. So great control aspects here to the 529 plan, very important. So what if my child gets a scholarship? Fortunately, with the 529 plan, any amount of a tax-free scholarship may be withdrawn from the 529 plan. It will be subject to normal income taxes, but it will not be subject to the 10% penalty, which would otherwise apply to a non-qualified distribution. So that worst case scenario, if you take a non-qualified distribution, what happens there? You will pay your normal income tax, right, on the capital gains or interest or so. And then you will also pay a 10% penalty on the earnings portion of the withdrawal, right? So you don't pay a penalty on your contribution. I think that's important to know. But if you get a scholarship, if your child gets a scholarship, you can withdraw that money without paying such a penalty. You will have to pay the tax, as if it were a normal taxable investment account, but you won't have to pay that 10% penalty. So hopefully, that scholarship issue is pretty well assuaged. A 529 plan will not impact any scholarship opportunities that your child may have. Those are, based on merit or athletic prowess. And the funds that you've got in the 529 are not going to influence that at all. We discussed a little bit the financial aid. There's some, impact on the need-based financial aid there, but it's not going to influence, your scholarships or anything like that. I know some people were asking that in registration, and that's not something that you need to worry about. If your child earns the scholarship, you'll be able to get that back without paying, that 10% penalty. Moreover, at the end of this past year, we had this great piece of legislation pass, which is going to enable 529 to Roth IRA rollovers starting in 2024. So this is not going to apply to anything that happens until January 1st, 2024. So don't go and try to roll over your 529 plan into a Roth IRA right now. But this is an awesome provision, that I think helps assuage that biggest concern that I think a lot of you all have is, what if my child doesn't go to college, or what if there's, some money left over in the account? I don't want that to, have some sort of a penalty, which is, definitely reasonable. So, starting in 2024, we will be able to roll over leftover 529 funds into a Roth IRA for that same beneficiary. There are some restrictions here, which I think are reasonable. They don't want people to be just funneling money, through a 529 plan right into a Roth IRA, taking, state tax deductions. So I think that that's reasonable. We need the beneficiary of the 529 plan and the Roth IRA to be the same. If you're thinking about saving for one specific student, really not a concern for you. The plan does need to be open for at least 15 years. So I think that just kind of adds to the sense of urgency to get started today, and make sure you are able to take advantage of this provision if you need to. There is an amount limitation here of $35,000. But, based on the cost of college today, not a lot of people have more than $35,000 left over in their 529 plan after, their student goes to undergrad, maybe grad school, or further continuing education. So that does give you a nice opportunity to seed an IRA for them if you do have some leftover funds. All other Roth IRA limitations are still going to apply here. So the funding limitation, which I think this year is maybe $6,500 for those under 50. Maybe it'll be more next year, but that's still going to apply. All other Roth IRA rules are going to apply. So income limitations, and important here, the amount being transferred does need to be contributed at least 5 years prior. So again, not able to just funnel the money, directly through the 529 into the Roth IRA. So we will expect, further IRS guidance, of course, on all of these rules. That'll probably come, later this year. And we'll continue to, provide content for our users as more details become available. And we'll, have more of these webinars throughout the year so we can continue to discuss it. So at this point, I'd like to go ahead and open it up over into the audience questions portion of the show here. I do see quite a few already. So I do want to jump into those. First one about qualified expenses here. Great question, great point. And then it reads here, don't forget that you need to pay your tuition from another source when taking the AOTC, the American Opportunity Tax Credit. So you can't use the 529 funds and still get the AOTC. So that's a really good point. You're going to want to make sure that you subtract out, any tax-free educational assistance or tax benefits like the AOTC or the lifetime learning credit when you're calculating your qualified expenses for that year. It's a very good, correct point. Somebody asked here if a replay is going to be sent out. Absolutely. We're going to also send out, all of the links that I've thus far shared. I'll definitely include more, whether it be to answer some of the questions that I'm not able to answer, or to give you guys some more resources as you make these plans. So we will absolutely be sharing, resources, the replay as a follow-up here. Question here about the total amounts for the Roth conversions. Would you have to break it out over the multiple years to stay under the $6,500 limit? That's how it seems to be now. We're going to need to wait for further clarification from the IRS there. But it does seem that those limitations are going to apply. So then that $35,000 would be a total amount transferred over time. Questions about like the owner of a 529 plan versus the beneficiary of the 529 plan. Specifically, is it best to open the 529 in the parent's name or in the name of the child initially? And so the typical way of doing this, and what's probably best so that you maintain control, and also again you don't have to worry about the financial aid impact. You will want yourself to be the account owner, and then your child will be named as the designated beneficiary. And that also applies to grandparents. So grandparents absolutely can contribute to, say, the parent-owned 529 plan. And in many states, they can actually also obtain a state tax deduction. But a lot of grandparents do choose to open their own 529 plan. So again, they retain control of the account, because if they contribute the funds to the parent-owned 529 plan, they no longer have any semblance of control of those funds. And some of them, would prefer to do that. Clarification on federal tax incentive for contributions. So again, there's no federal tax deduction that you're able to claim, whereas there are in most states a state tax deduction from income. However, you do not have any federal taxes on the growth of the 529 plan. So you don't pay any capital gains tax, any income tax on interest, or anything like that. So the growth of those investments is not subject to your typical investment related taxes. A couple of questions here about changing beneficiaries, and then also what would happen in the unfortunate circumstance that the account owner dies. I'll be sure to include, we have some very good detailed articles about those specific questions, and I'm not really able to get into enough detail for you today, but I'll include resources on both what happens when the account owner dies, as well as changing the beneficiary on the 529 plan. Question on tax deduction limits for federal. Again, no state tax deductions available, or sorry, no federal tax deductions available. If you want to see what your state's tax deduction is, we're going to want to go back to this page here. I'm going to drop that in the chat for you all. The specific question was, just to give you guys a little guidance here, it was Massachusetts, right? So here you can see that for joint filers in Massachusetts, they can claim a deduction of up to $2,000 per year. So that's where you'll be able to see each of your states' tax benefit right here. Just trying to get that Q&A box back up here. Can leftover 529 funds be used for siblings' expenses? Yes, that will be further covered in the beneficiary changes article that I'm going to share with you all. Sorry, folks, just going through these questions here, trying to help you out. All right, so here's a great question. If the child does not go to school, right, we kind of discussed, what some of our options are there, but who, is in control there? And that's going to always be the account owner. Okay, the beneficiary doesn't have any, legal rights to those funds. So it will be, still the account owner's discretion there. That's a very, very good question. Here's a nice question. So this guest has a 529 plan in New Jersey, but their parents live in Pennsylvania. And so are they able to, receive any state tax benefits? So Pennsylvania is one of those tax parity states. So they're actually in a great situation where they're able to contribute to any state's 529 plan and still be able to obtain that deduction. So that's, pretty good for them. Great question here from Marshall. Is there an age where unused funds need to be withdrawn from a 529 plan? And no, and that's kind of another one of the great things about 529 plans is you can actually have it, stay there indefinitely. So, maybe your child doesn't go to school or to college rather, and you still have some funds there. You don't want to move it into the Roth IRA in 15 years. You would actually be able to change the beneficiary to maybe your grandchild down the road. And all the while, you'll be able to continue to have those investments and growth from those investments all tax-free. So there's not, a limitation on the length of enrollment in the plan. Very good question there. Question on scholarships. So yes, the amount of the scholarship does come out penalty-free, but as I understand it, it does it is still subject to tax, as it would, any other capital gain or interest income. At that point, it's probably a long-term capital gain, so it probably has a muted tax impact. But you will need to pay, your typical tax. You just will not have to be subject to that penalty. Looks like somebody would like us to share the slides. We can definitely include those slides. I will say, the links and resources will probably be a little bit more helpful because you're going to want to take a look at, your state's specific provisions. So if your child goes to school abroad where higher education is free, so the idea here is that they don't incur, any expenses, even at, the eligible institutions in the foreign country. There is not a provision right now that allows that to be that allows those funds to be removed tax or penalty free right now. So if you were to still make a withdrawal there, that would be subject to that penalty. That would be a non-qualified distribution. Question about the Roth provision here of Secure 2.0. When if you change the beneficiary in the 529 plan, does the 15 years start over, or can you use, if for the original beneficiary? We do expect that 15-year clock will start over, to prevent people from making those changes. That's another thing that we're going to have to see with the IRS guidance that comes out, but we do expect that clock will restart, unfortunately. If there's some money left in one of my child's 529 plan, can we move that to another child's 529 plan? So I think that's going to also fall under the beneficiary change. You could just change the beneficiary of that original 529 plan. So we'll get you more information on those beneficiary changes. Can you open 2 accounts with like the same name and email if you have 2 kids? Yes. You can have actually as many 529 plans owned under your name as you want. Our founder, Joe Hurley, when he was researching all the different 529 plans for saving for college, he went and opened up a 529 plan in every different state. So it is a possibility to have essentially as many as you want. Oh, really good question here. When we're talking about like different college savings options, a great point is they're not mutually exclusive. So the question here was, would it make sense maybe to have an additional covered out ESA? This is an account that has some more flexible investment options, but there's a very low minimum or a very low maximum contribution each year. I think maybe $2,000. And so might it make sense to use them in combination? That's absolutely a possibility. There's no reason to say that you must only have a 529 or you must only have a covered L, or if you have a 529, you may not open a covered L. There's no reason for you to not, come up with a strategy that works best for you to help your kids save for college. And you're able to open up as many as you want. Great question from Kristen here about non-qualified withdrawals. So that 10% penalty, yes, it only applies to the earnings portion. You're never going to have to pay a penalty on that initial contribution. So what I mean there is you have contributed 10,000, let's say, keep it simple, to the account. It has grown to 20,000. So you take the 20,000 out for a non-qualified expense. You will only pay those taxes and penalties on the $10,000 of growth. So you don't have to worry about your contribution itself being slashed. So that's an important point, I think. Also, it's not going to be like the 10% off the entire amount. There have been a few questions about moving. And so I'll include an article about 529 plan rollovers. This is absolutely a possibility. Most states don't have any serious restrictions on doing such a thing. There are a couple of states where you may be subject to a state tax recapture. That's another thing that you can actually find here in this comparison tool. I think there are very, very few that actually do so. But here we look at like state tax treatment of rollovers might be relevant to you. And state tax recapture provisions here. So you'd be able to see specifically, what provisions apply to you here. So like most states, right, there's tax-free treatment of rollovers from another 529 plan is what that means there. Can parents deposit funds into the accounts that grandparents opened? Yes, that's a possibility. All 529 plans do accept third-party contributions. So anybody is able to contribute. Many of the plans offer very robust gifting platforms where you can maybe have some people set up little profiles that allow them to very easily give gifts for birthdays or holidays or so. So that's definitely something that a lot of plans have been trying to encourage, right? The gifting contributions and have made it as easy as possible to do so. Is it beneficial to consider an out-of-state plan for a state like Texas, especially if there are no tax benefits and when other plans offer lower fees? So yeah, that's absolutely something to consider. And I would, take a look here using these tools, on saving for college to see what plans offer, more attractive fees or more attractive investment options for you. 529 beneficiary must be the Roth IRA beneficiary for the rollover to the Roth IRA. That is correct. Somebody asked that there. Okay, a question about grandparents and financial aid again. So yeah, it was previously the case where grandparent 529 plan distributions would then count as student income, so be assessed at a very high level when you're calculating your expected family contribution. But that's no longer going to be the case now with this recent FAFSA simplification. So for anybody applying for financial aid now in the future, that's not going to be a major concern. There's a question here about super funding and grandparents super funding. Yes, grandparents absolutely can super fund. They're most likely to, given that they generally have a little bit more in assets available. And the idea there is you're able to spread out the $17,000 gift tax exclusion over 5 years, right? So you can actually deposit $85,000 tomorrow into the 529 plan, and you will not need to use up your gift tax lifetime exclusion as you might otherwise. And yes, Aziz here, now now that the grandparents contribution is not considered student income, the financial aid is truly not affected by a grandparent's 529 plan. Contribution limits, again, definitely take a look at our comparison tool. Gonna share that once more here. If you take a look right here, we can see our maximum and minimum contributions. And what you'll find is the maximum contributions are very high, right? These are typically $400,000 or $500,000, and the minimum contributions usually around $25 per month. So you have a really good accessibility, whether you can only contribute a little bit or if you want to contribute a lot. On an annual basis, if you're not going to make that 5-year gift tax declaration we called super funding, you're going to want to keep it to $17,000 in contributions per year. That's just so you don't have that count toward your gift tax exclusion. And once you hit the gift tax exclusion, you'll now be subject to a gift tax. So as long as you keep it under 17,000 for this year, that'll be okay. It's gone up by about $1,000 each year over the last few years. So that's of course very much subject to change. So here's a parent who's studying in grad school and would like to know if you can use the 529 for yourself also. Yes, absolutely. And the $10,000 student loan limit, right, is a lifetime for both you contributing to your student loans, and then your son if they are, if they want to use those 529 funds on student loans. Is there a scenario where the money I save in a 529 is lost? That is, it can't be used and the money is gone. So you can always take a non-qualified withdrawal from your plan. And that, again, will be subject to your normal investment taxes and that 10% penalty on the earnings portion. But you'll never be locked out of your account. Now, obviously, if you are investing in, market instruments, there is that risk there. Fortunately, a lot of the 529 plans also offer, FDIC insured or stable value investment options. And so there, you don't need to worry as much about that market risk. But obviously, the return opportunity is lower. Can you invest in another state's 529, or does it have to be your own state's? You may invest in any state's 529 plan that you wish, whether you are able to get a state tax deduction or not. Obviously, that's probably the first consideration you want to ask yourself, but you're under no obligation to invest in your state's plan. I will say there are certain states which do restrict enrollment to their residents. So it's not necessarily the case that you can invest in any plan out there. Can 529 funds be used for travel and lodging expenses while studying abroad? Definitely be careful there. For travel, it will not be a qualified expense. Even though you may need to incur pretty significant expenses to study abroad, but travel is never going to be a qualified expense. Lodging, maybe, again, only up to the amount listed on the cost of attendance figure for your school, but there it would be okay. So somebody here's heard that if they have a 529 plan, then there's a possibility that they're not going to get considered for scholarships or grants. How much of this is true? Again, it's not going to influence scholarships whatsoever. Scholarships are merit-based or athletic-based, so it's not going to influence it there. Again, there is a slight impact to need-based financial aid. But we go back to what we discussed, right, with the savings versus the loans at the beginning of our presentation today. And saving is a much more attractive option than having to maybe have student loans down the future. Great question here, I think, to end, and that's where can we find your future webinars? And we will absolutely be promoting those here to all of you. You'll get all of our emails following our follow-up today. Our next 529 plan focused webinar is going to be for 529 Day, and that will be held on the 31st of May. So it's a couple of days after Memorial Day there. And we're going to be going, even further in depth into 529 plans. We'll definitely have at least a couple of financial aid focused webinars throughout this year. So we very much hope that you do join us for those. So keep an eye out in your email here this afternoon. I'm going to share the recording once I'm able to get that up into YouTube, as well as all of the relevant links and resources that I promised all of you, including the slides, so that you're all able to get all of the information you need. We thank you so much for joining us. I'm sure that your students are going to be incredibly grateful that you're putting in this effort to try to make a better future for them. And we're really happy you joined us, and have a wonderful rest of your afternoon.